Welcome back to the channel, everybody. I have the amazing opportunity of interviewing Will Rhind from Granite Shares ETFs, which is going to be just a blast. We've got some questions set up, of course, but first I want the people to get to know you a little better, Will. If you could give a little bit of your background, any information you'd like to share, that'd be great.
Absolutely. So first of all, thanks for having me, Spencer. Pleasure to be here. For those that aren't familiar, my name is Will Rhind. I'm the founder and CEO of Granite Shares. We're a ETF firm or exchange traded fund company that we're an asset manager, but we specialize in ETFs. I'm from Scotland originally, but now live in New York, as you can probably see from the background. But I've been here for 15 years now.
Wow.
And started the business in 2016. But I've been in the ETF industry for a long time, going back to the early 2000s. I've been doing this longer than most in terms of the ETF game. I started my own business in 2016. We've grown that significantly over the years to about 9 billion assets under management, with products listed here in the US on the major US stock exchanges, in Europe as well. And then we have a team in Asia where we do marketing to different countries over there.
Excellent, excellent. And we're going to get into all these details and more, which I'm super excited. I will say, I was writing these questions and I was like, whew, there's a lot of information that I want to know personally, just as an investor, not even, from the interview point of view. So I'm really excited. So we'll kind of get it going here. Firstly, what was the inspiration to create Granite Shares, and how does the company distinguish itself from other ETFs?
Sure. So I think you're going back to my experience, right? I've been in the industry for a long time. I've worked for 3 different ETF companies, from BlackRock to I was the CEO of the GLD, which is the largest commodity ETF in the world before starting Granite Shares. I think when you're in the position of being in any industry, after a while, and I've been in the ETF industry for some time, you obviously get to a position where you ultimately say, hey, you know what? I can do this myself, and I can do this better myself, whether it be providing a better product at a lower price. And so I think fundamentally we're in the ideas business. So we have a lot of ideas. And I think at the end of the day, you have to ask yourself the question, if the ideas are that good, then why don't you back yourself and launch them yourself? And so that's exactly what we did with Granite Shares. So the inspiration, if you want to look at it that way, was that at the time we had a simple problem to solve, and that was that commodities, where we were kind of spending a lot of our time, were very expensive and kind of a niche market and not particularly well structured. So it was a simple sort of way we looked at that market and said, you know what, we can offer a better product at a lower price. And we came in with what was at the time the lowest cost sort of core commodity offering. And that was the start of Granite Shares. So we offered our low cost gold ETF, which is BAR, which we obviously still have today. It's over $1 billion in size and is less than 50% cheaper than the GLD, which is the largest gold ETF. We have other commodity products which were lowest cost in the category with no K1s, and K1s are like a really annoying thing come tax time that certain investment vehicles spin out. So that was sort of the start. And then, like most firms, we went on a journey of creating products that, hopefully investors love in all sorts of different categories. And so what defines us, or what makes us different, is we like to think of ourselves as operating in an area called high conviction investing, which simply means that that's like a more exciting product range than your sort of, generic core index ETFs. And by the way, there's nothing wrong with those. It's just a different type of investing and different type of customer. So we're catering to people that want like a bit more sort of exciting stuff, a bit more spicy stuff in their portfolio. So that's going to cover everything from the likes of commodities to leverage to high yield. And that's sort of where we sit in the investment landscape.
Excellent, excellent. So much good information. I'm still really excited. I got the adrenaline going for this. It's good to see you again. It's been a while since Vegas, and that was amazing. I mean, you guys know I went to Vegas for a trip, met some amazing people, other content creators, and Will was the one behind that. So we had a great time. Back to Granite Shares. What is the long-term vision for Granite Shares?
I think that this is kind of an interesting one. So I think as a company, clearly what we want to do is continue to grow, continue to launch great products, expand both in terms of the diversity of the products that we offer, diversity of customers that we have, and then the regions that we operate in. So, I mean, ultimately, we want to take this, to maximize its potential, which I think we've got a long, long way to go. But, hopefully we can keep doing this for a number of years still.
Excellent, excellent. On to what I think will be really, really important for my channel specifically, the Yield Boost ETFs, which I have made content on these. I've made content on a couple of the other ETFs, and people are always in the comments asking about them long before I even knew that they existed. What was the motivation behind this series of ETFs, the Yield Boost ETFs?
Yeah, so Yield Boost, like a lot of things that we do, we try and do things that are first to market. So covered call ETFs and not something that was new. I remember coming to US like 15 years ago, a meeting with, financial advisors and people at that time who, people were writing calls themselves. In other words, selling calls on existing stock positions. But it was a fairly sort of niche business. Over time, clearly that's gotten a lot more popular. And specifically in the last few years, you've seen a lot of covered call ETFs. So I think it was in part to say, hey, look, is that the best that we can do? And can we create sort of a better way for people to generate yield? And then also, can we do it in a differentiated form? In other words, can we offer something completely unique? So Yield Boost is the first put spread strategy. So we'll get into that in a second. But effectively, we're selling put options instead of selling call options. The payoff is very similar. But what makes Yield Boost different is that we're also buying put options. So to try and minimize the downside on that. And then really the kicker for Yield Boost, what sets it apart is the options that we use, the options that we sell, the options that we buy, they're options on underlying leveraged ETFs. So the reason for doing that is that the implied volatility you get in options on stocks is quite high, or options on indices can be high. But if you imagine the implied volatility on a 2 times leveraged ETF or a 3 times leveraged ETF, it's going to be 2 or 3 times. Therefore, the amount of premium or yield or income that you receive can be a lot higher also. So the kind of the killer app, if you will, is that the Yield Boost funds generate very high yields, and they're doing that because they're selling puts on underlying leveraged ETFs, which in turn have a lot higher premiums than your kind of average strategies on underlying stocks.
Oh, that's a really good explanation, because when I made the video, I did a deep dive into everything, and I would say I'm not like a novice with options, but I don't personally love them. It's never been a big part of my trading. So what I do is I buy ETFs that do all that work for me. And that's
absolutely.
And that's what I enjoy. I used to try, usually every week, I would be trying to, covered calls and whatnot, researching, and it just started taking too much time. And I realized, like, I can have someone do this for me for a fee, and that's just the way that I like to trade, more passively. So that's a great explanation, and I think it's definitely something active investors are looking for, rather than, some people like to write their own, and that's great. If you're good at it, I recommend it. But if you're like me and you're lazy and you're not really good at it, I like this option better. So that's great. And you answered a few of the questions all in one, which is great. Next question. So how are they able to generate such high yields, and is it sustainable?
Yeah, so first of all, the reason we can generate high yield is just because the implied volatility is higher. So if you take something like the S&P 500 or the NASDAQ, it's going to be quite similar. So the yield on the S&P or the NASDAQ is lower than the S&P, but the yield is like 1.2, 1.3% or something. If you just buy a regular S&P 500 ETF, doesn't matter from who. Now then you say, okay, well, what about if I sell a covered call? So I sell an option on that particular index, and that's where you get to several covered call ETFs that are doing exactly that. Those yields are going to be around the, again, 12 to 11, 12%, something like that. Then you take something like the YSPY, which is the Yield Boost version of S&P, or TQQY, which is our NASDAQ 100 orientated one. Then you're talking about, we're selling a option on an underlying 3 times leveraged ETF. So the yields are going to be around 50%. So take that yield you've got for the S&P of like 12%, something like that, treble it and more, and you get to the yield boost type range. And that's just because you're going to get higher volatility for leveraged ETFs, higher implied volatility for the options. So we're trying to take advantage of that premium arbitrage. And that's really like the kicker. So when you look at a yield boost ETF on Tesla, single name, and you compare that to, say, another covered call from another competitor that's not using it, then I think the last one was something like 150%, for TSYY versus, which is still impressive, something a lot lower for the equivalent covered call on Tesla stock itself. Just a lot higher yielding. And then because we generate, such high premiums, we can afford to use some of that premium to buy puts, to protect against the downside, which is, of course, the weakness of any covered call strategy or option selling strategy.
Definitely. And we get that all the time. Us YouTubers, we get the comments about NAV erosion, and we've seen some things just, I will say my first covered call ETF, I purchased it early on in like 2020, and it just underperformed what I was hoping. And so I had to come back into it these last couple of years and realize there's innovation here. People are changing things. And when I was on the Granite Shares website, checking everything out, I was like, wow, well, there's more depth to it. Understanding it takes more time. And I really when I looked into it, I was like, oh, that makes sense. And you kind of have that light bulb moment when you're checking it out. And I'll link the website down for people to check out and see for themselves, because it's really cool. And it's a good learning opportunity as well to see how these different companies are doing different things. So that's phenomenal. Jumping into our next question, probably one of the biggest things that we've talked about this year are weekly dividends. So can you touch on Granite Shares? What's happening? Are we ever thinking about weeklies? Give us just the rundown on that.
Yeah, absolutely. So at the moment we do monthly, but we may or may not have a big announcement coming up next week on that. So, like anything, we're always looking to iterate. And, we had a lot of feedback from people about weeklies. It makes no difference to us in terms of when we do a payout. So if that makes it easier for people, that's something that we'll listen to. But yeah, watch this space for Granite Shares, particularly for next week.
Excellent. Do you have a personal favorite of the Yield Boost ETFs?
Ooh, great question. I don't have a personal favorite. And the reason I say that is because they're a bit like children, that you sort of love them all equally. And I think the fairest sort of way I can say it is when you have different strategies, which they are, the favoritism, if you will very much depend on what's doing well at that particular time. So if you take the leveraged single stock universe, then it's easy to say like NVIDIA would be our favorite because that's our biggest one. That's just been phenomenal returns for investors, been amazing. But if NVIDIA suddenly was to go down and it was replaced by, an SMCI or, whatever, then that probably might be our favorite time. So it's a bit like with Yield Boost. I think, if I had to say, if you forced me to say something, I would say the Tesla, TSYY, just because that was our first one and that has the longest history. But, we're trying to build a big family here.
Definitely. And I think the Tesla one also is probably my favorite. I've been trading Tesla. It's one of like the first stocks I ever purchased. And so I love to see that. We'll have more questions on those coming up as well. What I'm curious about, and I think what a lot of people are curious about, is the market environment we're in right now is interesting. We've seen just in 2025 some drops, some coming back up. What would the ideal market look like for these Yield Boost ETFs for them to continue these crazy payouts that we've seen? Sometimes depending on the options with more implied volatility, you want a kind of crazier market or maybe something a little slower. Can you just give a little insight into that?
It's a really great question because there's not an ideal answer to it. It sort of depends on what your investment objective is. I could tell you that the best environment for these products would be one where the underlying, whatever that underlying is, goes up sort of steadily over time. But not too much because you're selling the premium and therefore you want to harvest that as your income. But then I could also tell you, and that would be somebody who's optimizing for sort of total return. Then I could also tell you that a great environment would be one where there's a lot of volatility. And the reason why it's a great environment is because what you're doing effectively, if you imagine volatility as being an asset class, then the more the stock market is volatile, the higher the volatility, the more premium that can be harvested because you want to sell that asset when it's high. You don't necessarily want to sell it when it's low.
Mm-hmm.
So this year, some of the yields that we've been able to achieve have been really high because the VIX, which is one measure of volatility in the market, at certain times has spiked to very high levels. So if you're a seller of volatility, then by definition, you probably want the market environment to be volatile because that enables you to get juicy premiums that then you can take as income. So it's kind of two different
Mm-hmm.
takes on it. That for the income investor, they probably prefer something a bit more volatile. To the person who's maybe optimizing for total return, it's more that, steady path upward over time.
Yeah, definitely. Thank you. That's a question I've had for a while, thinking about all these different ETFs and what works. So that's a good piece of knowledge for sure. We did speak on leverage a little bit, so I want to reach into that area. In your opinion, what is driving the increasing popularity of both leveraged ETFs and overall use of leverage in the market, I would say, even when it comes to terms like with margin and whatnot? In my view, I've seen it increasing quite a bit.
It's simple risk reward, the basics of life, the basics of investing. I think that it comes from the simple desire for people to, optimize whatever their, financial situation is. And, clearly if they have the risk appetite, that it's the ability to earn two times the return if you're two times leveraged or three times or whatever it may be over a given period. So just that sort of suppose desire for people to take on risk, desire for people to enhance return or enhance, profits. It's the same thing driving, motivation since the dawn of time. It's like the opportunity to potentially make more money with the same or less capital put out.
Definitely. Great answer. I was never big on leverage until more recently I've realized, well, in my opinion, markets go up, right? And that's kind of how I've seen it. I've been trading stocks since I was like 17, 18 when I first had like a summer job, and I've been watching my dad do it his entire life. And I realized just in that time span of the last 10 years, if I had applied the leverage, where would I be at compared to where if I hadn't? And so it's really interesting. And I think a lot of, I would say, more retail focused investors are realizing that as well, where things are expensive now. It's harder, and even if it is more risk with leverage, it's harder to get rich. It's harder to, be ultra successful. And so leverage can play a role on that for those that have less starting capital and are okay with just higher risks. So
Yeah, you hit on a good point, which is, look, if you think about the sort of the good old days, right, where the first thing you probably do is try and buy a house or buy an apartment. How do you do that? Leverage. You're using a mortgage, you're borrowing to do that. And the reason you're doing that is because you want to borrow as much as you can. One, because you can't afford it, but two, because you know that over time, hopefully, that's the best way to build equity in whatever it is. But now it's very difficult for young people to do that because the prices of real estate have gotten out of reach. And so, in a way, to expand on what you were saying, Spencer, it's like you've got to play catch up. And so for young people, the only way really to build wealth nowadays is to invest in the market. So number one, you have to be in the market because you're not in the real estate market. And then number two, you've got to try and do what you can to enhance returns to build wealth. And I'm not saying that leverage is by any means the only answer, but it's one tool in the toolkit that people can deploy to reach whatever financial objective that they're trying to get to.
interesting. Great point. That brought another question I have, not even on my list. I wanted to ask. I mean, what I've seen, and I've been investing for significantly less time. I'm not necessarily in the industry like yourself. I think we're seeing such a shift into more income focused stuff for people to maybe even like pay their bills. And for me, I like to reinvest. I use a drip, so I like my ETFs to make me more money and buy more of the same ETF. Have you seen that over, the last couple of years? Is that something that's pretty common with ETFs? Is the income focus side of things seems to be growing? And if so, why do you think that is?
It's gotten a lot more popular. And people will probably give you different reasons. And there is, of course, like all these things, there's never just one reason.
Mm-hmm.
I think a main or a big reason is that people have been burnt by bonds. And, traditionally, I guess fixed income was the sort of stock answer to how people generated yield or generated income. And, clearly we had an environment up until really quite recently where, bond prices pretty much always went up because yields were going down. And I think people sort of now coming to the realization that, having zero interest rates or even negative interest rates was maybe just a moment in history
Mm-hmm.
that will never be repeated. And in that environment, clearly people were screaming for yield, and therefore people were, trying, like people like us, were trying to design products that, were able to give people yield in a world where we didn't have yield. And then as we climbed back up to a world which we're in now, where we do have, real interest rates in the market, and you can earn, yield from a money market fund, finally, or even bonds, people have realized that, that depending on when they bought and what they bought, but people have lost money in different bond ETFs, different, even treasuries, particularly the longer end of the curve. And so people have realized that their sort of risk-free assets are actually not risk-free at all. And in some cases, people are sitting on mega losses, and it's part of the reason why Silicon Valley Bank and a bunch of other regionals went down because of losses in treasuries. So people are now starting to look beyond that and say, well, there are other ways that we can generate yield, and perhaps ways where we're not so exposed to things like duration risk, and options-based income products are certainly one of those things that people are now turning to. So it's like that alternative to fixed income, alternative to bonds, which we're starting to see of.
Wow. There's so much to unpack. This has been great. I'm asking some of my own personal questions too, just things that I want to know. I think we're kind of, in that time where innovation seems to be everything moving forward. And I like seeing, I remember when there were the first monthly was all the hype with these income ETFs. And then there were some weeklies that were launched. And I remember everything was shifted. And I spoke to my father about it because he loves dividends. He's only ever received them quarterly, and even in some aspects yearly. And so when I told him, oh, they're talking, there's a lot of monthlies now, he's like, no, like that's not my style. It's not what I'm used to. And then the weeklies, he's like, I don't even believe it. He just doesn't believe it. And he's not necessarily an active investor. So he, buys and just holds for however long. But it's really cool seeing the innovative side of this stuff come through, and seeing, businesses like Granite Shares listen to what people are wanting, and to be able to create something with the knowledge that you guys have and the capability that, someone just writing options normally would be difficult, not only to learn, but to implement over time. So awesome. Can we expect more leveraged ETFs from Granite Shares focused on popular stocks?
Yeah, no, absolutely. That's been a huge hit for us. So big area of the market that, really provides a real solution. So a lot of people, will question, the need for leverage, and, the reason that these things exist. But beyond that, what people don't perhaps realize is that they offer really two fundamental benefits. Number one, you're getting institutionally priced leverage at scale. So for the mass market, you don't have to go and go to your broker and pay the crazy margin rates that they're offering for that, and go through all the hassle. And then number two, there's no margin in the product. It's an embedded margin product effectively. So you're in control of when you buy and sell. It's not the broker stopping you out, or any other thing which potentially could lead to bad outcomes.
Mm-hmm.
So from that perspective, really offers those two kind of key benefits, which I think some people sometimes don't quite realize.
Yeah. Oof. We've seen some issues with brokerages in the past and whatnot, and it's interesting. That's a side of, to get into the legal side of it as well, where I'm just like,
Yeah.
outside of my reach, and for good reason. I'm not interested in it as much. So that's a great point. I never even thought about that aspect with margin, and how, you're in full control when you buy something with leverage, and you don't have to have access to certain amounts of margin and whatnot. That's a great point. I'd never really thought about that. For both the leverage and the Yield Boost ETFs, how do you guys select the underlying stocks? Is it popularity? Is it any insights on that would be great.
So on the stocks, the start with single stocks first, its popularity is definitely a big factor. But it's also the case that what you think of as being popular stocks are not necessarily popular stocks for leverage trading, which may sound kind of counterintuitive, but I think that takes a certain type of stock that people want to, to speculate more on. So it might be the case that, for example, you might have a huge stock like Walmart. I'm just picking a name because we don't have it. So it may be the case that that is interesting for people to trade leverage on, but it may also be the case that's a super popular stock, one of the biggest names out there, but there might not be any interest in a 2x levered Walmart. Whereas there's a lot of interest in names that move a lot. So I think volatility is part of it, that people are looking for those because people are short term, right? People are not in these products for long term. This is not something you put in your pension fund. People are looking to trade these over a day or over a short period of time. So they're looking for those stocks that, big moves. So you see a lot of interest in stocks like, SMCI or, IonQ, things like that, which, move around a lot as of course the big stocks, the Teslas, the Nvidias, the AMDs of the world, which populate big themes. So it's that sort of intersection between what stocks are really popular, what stocks are part of a big investment theme, and then which ones do people have an enthusiasm for kind of leverage on? And it's kind of a marriage of all of those.
Wow. I never really thought the theme side of it as well with, just what theme is hyped up
Yeah.
in the market.
AI, crypto, there are others obviously, but those have been the big ones of the last 2 years. So anything AI related, anything crypto, broadly speaking, that's been the right sort of bullseye for the market in terms of, what people are looking for theme wise.
Yeah. Wow. This next section is more on the audience and market trends. So when it comes to Granite Shares ETFs, do you have one specific target audience you're looking for? Or is it just kind of you create it for people that you think will be interested and there's no select target?
So if I can say the target audience is what we call do-it-yourself investors. That means different things to different people, but it's not a generation or an age sort of stereotype. It's not a wealth stereotype. It's just people that manage their own money. And that could be someone who's in their 50s or 60s, or that could be someone in their 20s. It could be someone who's very wealthy. It could be someone who's just starting out. So what they all have in common, and this is the global sort of trend that we are tapping into, is they're all managing more or taking control of their own investing in a way that was not possible, first and foremost, like 10 years ago. So this is all about the rails that have been built by fintech, companies. And then the information that's available today has never been better than it has been before. When I was starting out, there was just a massive asymmetry in terms of what we had as professional investors versus what a do-it-yourself investor would have at home. The gap has been closing ever since. Now, I would argue that there's really no informational advantage left other than something nefarious, which I'm clearly not talking about, between your do-it-yourself investor versus your professional investor. So it's just, people that are in control, people that are passionate about investing, people that want to do that for themselves. And the super macro trend here is that you have more and more people around the world doing this. And so there's a huge movement of people and it's growing bigger all the time.
That's so interesting because I'm comparing that to what I see from just my channel, right? And the accuracy is like scary because I get comments from investors in their 80s that are starting out even. Some, have a large sum of money.
Exactly.
Some are starting with little. And then I get some that are in, oh, I'm 18. I want to buy my first stock, my first ETF. What do you think? What are you looking at right now? And so that's really interesting because I do feel like we've seen a shift where that wasn't, like you said, 10 years ago, things were drastically different. You'd have a primary focus, I imagine, on financial advisors trying to get them, with their clientele and whatnot. But
and let's be honest, the market's just a lot more important than it ever was or ever has been. So, with global wealth increasing, with the relevance, with global wealth increasing, people's net worth increasing that's invested in the market. And, as that goes up, then the importance of the market also goes up, if that makes sense. And
Yeah.
therefore, people's interest in the market by definition goes up and its importance. And that's why I think you've seen the market act as guardrails to some of, President Trump's policies, on tariffs, et cetera, whereby, you're seeing reaction from the market, being that guardrail against perhaps the more extreme expressions of the tariffs. And so again, that's the importance of the global wealth, people's money at work, and ultimately that I think brings the focus back home.
Wow. This I feel like we're almost doing like a course here. I've seen people discuss this stuff. It's so nice hearing from professionals in the space. So again, thank you for coming on. But I have more questions. Not for you to leave quite yet. When it comes to the fees of all ETFs, I'm curious specifically with the high income ETF, HIPS, which I've done a video on. Why is the fee for that higher than for some of the other ETFs like the Yield Boost ETFs? What ties into all of that?
Yeah, that's an outlier. So the complicated sort of answer to that is there are really two types of fees. There's management fees. Management fees are taken directly out of the assets of the fund. So if I use our gold ETF as an example, because sometimes it's useful to sort of imagine something tangible, that we charge 17 basis points or 0.17% on the gold. What we're actually doing is, if you imagine like we're shaving off a tiny bit of gold every month to pay for the cost of the storage of the gold, insurance, and everything else. Now, in reality, it's not clearly a tiny bit that's literally shaved off, but think of it that way. And that's what's happening with a management fee for the fund. And so like a tiny bit of the fund's assets is being sold, is being used to pay for the expenses. With HIPS owns some really interesting assets. So it owns MLPs, which are oil and gas infrastructure assets, pipelines typically, and it owns a thing called BDCs, and that stands for business development companies. And BDCs are kind of like shadow banking entities that lend money to small and medium-sized businesses. They're private equity-like, they're money lenders sort of effectively. And BDCs have a unique tax, so they're taxed as registered investment companies, which is the same category as a mutual fund or an ETF, as opposed to corporations. When you buy shares of Apple, all the cost is in the price of the share. So you'd never think about breaking out the cost of the share into like, oh, okay, what are the expenses in Apple? And oh, hang on a minute, but the share price, I'm paying a 10% management fee for Tim Cook and everybody else. Whereas with a BDC, that's exactly how it's disclosed. So it's just a weird quirk of the tax law. But what it means is that all those costs, all those fees, they're still in the share price, just like a stock. It's just the way that the SEC disclosure, we have to disclose it like a fund. And so you get this extra, they're called acquired fund fees and expenses that we have to display, but they don't come out of the assets like a management fee. So at the end of the day, you're paying the 70 basis points for the fund management, but the extra fees that you see are not real fees that are being incurred as the fund is selling. They're just disclosed in the underlying, some of the underlying holdings.
Ooh.
But yeah, it's a complicated sort of thing of tax law. I should do a video on this particular subject or an explainer on it, because if you're not familiar with BDCs particular, it probably seems a bit weird. And you're like, really understand that. But
I'm a fan of BDCs, and with MLPs, I'm less. I might have one or two, but yeah, BDCs are kind of what I started talking about on YouTube actually.
Really?
And
Okay.
REITs as well, and so that's something I didn't even know. That's really interesting because I always thought it.
Yeah, if you look at some of the BDCs, you have like a 5% expense ratio, but obviously you're not paying 5%. It's just the way that the tax law works and the disclosures that have to be put in place.
Oh, that's so interesting. I'm gonna have to go back and look at some BDCs I've passed on
Yeah.
because I figured it would be the other way. That's a good point. I may be missing out on some good returns because I was like, oh, it's too expensive. They're trying to, gouge me. But...
Yeah, there's now I'm thinking of it as an example I often give. There's a pure play BDC ETF as a plug for a competitor company from a company called VanEck. And VanEck have a pure play BDC ETF. The ticker code is BIZD or BIZD. So that ETF just owns BDCs. And I think that depending on what day you look at it, the expense ratio of that thing will be around 10%.
Yes.
So the management fee, I think, is like 50 basis points. So, it cannot be the case that you're paying 10% to own a product that I think yields 10%, roughly. So like, it doesn't make sense, but the product is very successful. So therefore, clearly if that was the case, no one would be buying it, which it clearly is not the case.
That's so interesting because I made content on that ETF probably about a
Oh,
year ago.
okay.
Yeah, a long time before I realized, what I'm learning today, which is amazing because I've been doing this for a long time. I'm still continuously learning. People in the comments put an experience like this is really eye-opening. And I passed on buying it because I simply was like, I thought, I was like, how is anyone buying this? It didn't make any sense to me. And I was like, there must be something missing here. Because I was getting comments like, this thing must be, it can't be real. No one would ever own this. It zeros everything out. And I was like, but I never looked into it because I was like, if it's complicated, I guess I'll just, keep going. There's other options.
You were like, there are hedge funds, and then there's this ETF that's charging like there's 2 and 20, and then there's 10%.
I was like, if I'm going to work for anybody, I want to work for them because they're charging. Oh, that's
exactly. I think that'd be front page of the Wall Street Journal if there was anybody that could charge 10% for a fund.
Oh yeah, that's so interesting. Lots of good information. I have just a couple questions specifically on partially your journey and some information that I think viewers would like to know. What is your take on this, the AI revolution that we've been seeing, and how do you see it impacting both, retail investors, financial advisors, everything kind of regarding the stock market?
Look, I mean, it's the most exciting thing that I've experienced in my lifetime. Forget about career, in my life. And I think that, the revelation that has been even the most simplistic forms. And I say to people that AI as we know it today will never be dumber than it is today. When people are, which I am, being blown away by, ChatGPT or Grok or, they're all great, all of the large language models. Those are never going to be dumber than they are today, right? They're only going to get exponentially better.
Yep.
And as Google, launches new products, the new video product that people have probably seen, it's been doing a bit of rounds on the internet. It's just mind blowing. And I think, maybe you could argue that my eyesight is not as good as it once was, but for me, we've kind of crossed the Rubicon where it's now impossible, certainly with that new Google product, for me to determine what's real and what's not.
Yes.
And, again, it's only going to get better. We know that, Elon's out there testing with autonomous, Waymo, we've seen it in all sorts of other sort of forms, and it's going to get real very quickly. In terms of some of these expressions that, will be game changing. And I think that the fourth industrial revolution, whatever you want to call it, it's going to be the biggest change in all of our lives. Much bigger than the internet, which obviously was the most significant thing in our lives, probably up to this point. And it's hugely exciting.
I couldn't agree more. The only thing I'm worried about is, that new AI video production system. It's going to put me out of a job here. Like that, I've seen some, I'm like, that is phenomenal where, and I would say I'm from the younger generations that can usually spot AI stuff. They're targeting, sometimes my parents don't understand if it's AI or whatnot, but we learn a couple tricks and whatnot. It's hard to differentiate between it. Nearly impossible from the naked eye, I would say. And it's scary, but it's also like, wow, that's crazy what they're able to come up with. And I think all the different aspects of using AI and in everyday life is going to just continue. So, but I always like hearing everyone's opinions because they usually get either a doomsday where they're going to take over the world, or it's the best thing ever. I'll never have to,
My view is that, that look, who knows, right? Maybe true, but I think that it puts more value on opinion and from real people than exists today. Like, for example, we all know that there are AI generated YouTube videos. Like if you can watch a YouTube video on something in the travel sector, for example, and you can see a nice AI generated video of a bunch of resorts that a computer's never been to or never stayed at, and I just find those to be completely useless. Like I actually I value somebody's perspective and somebody's opinion. And I think just like a lot of things in life, that AI will be amazing at certain things, but it will just put a higher premium on other things,
Mm-hmm.
and things like human opinion, or live events. There's a host of other things. It will de-emphasize a lot of things, but I think emphasize a lot.
Mm-hmm. That's a great point. Great point. Um, what is the most important lesson that you've learned from building a successful business? If there is one
Ooh,
that stands out.
I know. Yeah. There's so many. It's probably a different podcast. But I think probably if I had to distill it to one thing, is kind of a riff off of the work hard, but I'd put it like this, that persistence is such an underrated quality, that the ability just to kind of keep going, irrespective of, clearly in the good times and the bad times, but to kind of keep going and stay in the game, and almost like, wait for your opportunity to come. Because what you can't control is the timing. You can clearly control when you launch, or, when you start, but you can't necessarily control the market and the timing around, when your product or when your service is going to take off. So sometimes that's about, being persistent and staying in the game, and at the right time, you'll be rewarded.
Oh, excellent. Love that. Love that. Specifically, from your bio, which I was reading, you mentioned that investing isn't as exciting as it once was, and that Granite Shares is aiming to change that. Can you elaborate on what you meant? We kind of touched on this a little bit, but can you reiterate what you meant and give us the idea? Do you think that it's now changed in today's market?
So I was onto this a long time ago. So I started with that when we first started the company in 2016. And the reason for that, which is still the case today, you'll see lots of amazing statistics about the ETF industry. And there's all be like these gigantic numbers about how much trillions of dollars are invested in ETFs. The truth is, the vast majority of those dollars go into a handful of products. And those handful of products are the major indexes of the world, like the S&P 500s, the NASDAQ, etc. And I'm not saying there's anything wrong with that, but the vast majority of products are like plain Jane vanilla, ETFs, low cost, long-term buy and hold investing. And what there wasn't is the kind of the opposite to that. Like, what's the antidote to that? What's the exciting stuff? What's the thing that you look at forums online, right? It's never about that. The forums are about what people think about Nvidia or Tesla or autonomous or crypto or, this, that, or the other. But it's never about, hey, I'm buying my, all market ETF. And, there's a bit of that clearly, but I think it was really a nod to that. Now, many years later, quite recently, Eric Balchunas, who's a kind of well-known analyst from Bloomberg,
Mm.
and he's on X, if anybody follows him. He coined this. So I said, bringing the excitement back to investing, and we call it high conviction.
Mm.
He calls it hot sauce, which in many ways I think is perhaps an even better term for it. And hot sauce is about, as it sounds, like the hot sauce in your portfolio. So that your portfolio might be, the vast majority might be the sort of boring long-term stuff, but the things that you're actually passionate about, that you're actually going to research, you're actually going to do the work on, you're going to talk about to your friends, you're going to watch the earnings, you're going to do all that, are all of the hot sauce type
Mm-hmm.
investments you're going to talk about on YouTube.
Yeah.
So that category is turned out to be a really, really important, valuable, and growing category. So that category includes, like I said, the things that we're doing, like high income or high yield. It includes leverage, it includes crypto, it includes themes, it includes commodities. So whether you call it hot sauce, whether you call it high conviction, whatever, that's the space, that's the zone of the market that we play in. And that is just getting bigger and bigger.
Mm-hmm. I like that because you don't log into your portfolio and see what the S&P 500 did. You log in and go, how much money did this make? Did this make? Oh, that's
Yeah.
excellent. Excellent.
It's like high engagement stuff that's like really high engaging.
Of course, and that's what I see on YouTube is my best videos are the higher. It doesn't matter if they're risky or not. It's just what everyone seems to be talking about. That's what goes viral because it's a peak interest point for a lot of people.
That's right. Exactly that.
Oh, excellent. Last question. What is one piece of advice that you would give all investors, both experienced and inexperienced?
Ooh. I think it's probably one of the same thing, but the best piece of advice I can give is probably to have, always be mindful of time horizon. And, when taking risk, a lot of taking risk in life, which applies to investing and just in life in general, is you live a lot longer than you think. That investing is a lot longer, the time horizon is a lot longer than you think. And I think, that goes to some of the bad behavior that you see with people, for example, freaking out in April and selling everything at the lows, is that you have to sort of maintain that perspective of over a long enough time horizon, the market's going to be higher than it is today. And I think like before you start drilling down into what investments are good and bad, et cetera, like that's sort of the thing that has kept me sane for so many years. In that you become more. I think that's the way that I cope with a lot of the volatility, is just always thinking that you got to think about a time horizon that's way longer than the initial thought. So 10 years, 20 years, 30 years, 40 years. And that's kind of the right framing to be able to handle a lot of the volatility.
Oh, I love that. Yeah, the big picture. The big picture.
Big picture. Absolutely.
Well, awesome.
Goes on a long time. I think that's why you're seeing more, investors that are quote unquote older, getting involved with doing this themselves, because they realize that actually, if you're 60 years old, you're not that old. 70 years old, whatever, and you can still invest and do that, do what you're passionate about. And it's not the case that you have to be in treasury bills and short-term treasury bills, and that's the only thing. And God, if you do anything else, then it's going to be terrible. It's like, no, it's all going to be okay.
I like that. Well, excellent. That's all my questions. Do you have any closing thoughts or anything you'd like to share?
Yeah, I mean, I think just for anybody that's interested, hopes that, what I said made a modicum of sense, look at graniteshares.com. That's our main website. You can see all of our products there. We have an account on X. We're on LinkedIn. We have a YouTube channel. All the sort of usual places, our Substack as well. Please subscribe. But anything you've got questions on, please feel free to approach us. We'd be more than happy to answer any queries on any of the things that we do.
Excellent. And I'll be linking all the information in the comments, in the description for everyone interested. Go check them out. You'll learn a lot, just like I did. But again, I want to thank you, Will, for coming on the channel. It's been amazing. Would love to have you back, maybe in 6 months to a year. We'll see how the market does. And if you've got time for us, I know you're a busy man.
Will do.
Awesome.
Always me.
Awesome. Well, thank you so much.